Lastly, we have the cash flow statement. This is essentially, as I've mentioned earlier, the lifeblood of every business. Cash is generated from your business on different levels, from your operating activities, your investing activities, and your financing activities. And of course, if you want to remain as a viable business, you strive to ensure that your cash flow position, you're monitoring your cash flow, and you're also managing your expenses, ensuring that at no point would you be cash trapped, whereby you have positive cash flow. That's like the ideal position for you. So now, what are those factors that drive profitability? I've mentioned over the course of the presentation. You've mentioned, you've heard terms like revenue, costs, and of course now we're going to introduce operational efficiency, essentially where Yusuf hammered on today. For revenue growth, there are very key factors that you have to identify. First of all, price and quantity are two major components in your revenue generation. You want to increase sales because at the end of the day, the more sales you have, the more the potential of you achieving your goal for profitability. You also want to introduce multiple income streams in terms of having like a multiple customer base. You don't want to have products on your shelf that are only targeted to a certain clientele. I mean, you also see like pharmacies these days have other services where they offer, and then other products like healthcare packages, or even like blood pressure monitors, all these other added services that could increase their revenue streams. Pharmacies are also introducing online presence. Like, the bid to do that is for them to increase the potential revenue that they will gain from customers, because you have overhead costs that you need to cover. And the more revenue you're able to rake in, the more your chances of profitability. And of course, you're also looking at your product or your service innovation. And it's a very competitive market. At the end of the day, there's several pharmacies that offer similar services and similar products as well. So you have to, differentiate yourself. That way you can also expand the number of, units that you're able to sell in your pharmacy. I mean, you can introduce things like medication synchronization, whereby you have regular customers, and then you're able to do reminders to your customers. Oh, you have this medication is supposed to last you a number of weeks. There's reminders to your customers, so that way it's also personalizing the sale and the relationship you have with your customers. So essentially, driving your revenue it's an all hands on deck situation, whereby you're constantly ensuring that you're making adequate sales to meet up. Now, in terms of your pricing, which is also a very key factor in achieving revenues, you have to adopt a pricing model that is in line with your market and in line with your business model, and that can ultimately help you to drive your revenues. I mean, there's several pricing models you can adopt in terms of, are you adopting a cost-based pricing, whereby you're putting up your margins based on where you're sourcing your items from, where you're sourcing your drugs from, and your landing cost and all that. So you're essentially making sure that you're sourcing from suppliers that are giving you the best rates. I mean, like shelf life. You're also looking at, are you looking at the competitive pricing in terms of, okay, what are my other competitors pricing my products? Are you also using like a value base, whereby you're providing other services, and then on the back of that, you're able to, put a price that would show the customers that, okay, this is a product that is serving me just not only the drugs, but there's also added services that I'm enjoying. So these are all some of the key, elements that help to drive your profitability in terms of revenue generation. Secondly, we have what cost minimization. Now, ideally, you have several costs that are direct, and you cannot, do without this cost if you want to, remain in business. You have to purchase your medication. You also have to, you have dispensing costs. These are key direct costs to achieving a revenue position. Now, operational expenses, there are some of these costs that you can minimize in terms of your rent. You can make sure that you have minimal expenses on your rent. I mean, at the end of the day, your core input is your inventory. So you want to ensure that you're adequately stocked, and at the same time, your medication is kept in a good environment and all that. But you're also trying to minimize the cost of rent. So you're not going for a very expensive location, or expensive fittings that would impact on your overall cost, because all this will impact on how you're able to achieve your profitability in the long run. You're also looking at, minimizing your interest expenses. One of the reasons why we have a product in shelf life that offers, a line of credit to our customers is because we are trying to also assist our customers to reduce their interest expenses on taking, taking credit facilities that are interest bearing. So you want to look at facilities that would enable that your cost keeps going down as a business. Again, I won't talk so much on the efficiency because my colleague Yusuf has done justice to this. In terms of your operational efficiency, it is too important because it keeps your lights on. It's important that you have your processes streamlined. You're able to track your progress in terms of your drugs, and you can do that also by automation. And Shelf Life offers, a product that addresses that as well. Lastly, your employee productivity is key. You have to ensure that your staff, they're adequately trained on the process and how to ensure that everything works smoothly. So what are the most important profitability ratios? Now, how do you measure this? Now, we've talked about some variables, the revenue, profits, the income, cost of goods sold, direct and indirect costs. How do you arrive at a figure that that you're making some level of profit? And I mentioned that the first indicator is your gross profit. Now, your gross profit is essentially your revenue, which is your sales. So it's a revenue or sales minus the cost of goods sold, minus the cost of acquiring the drugs, which are like your initial direct cost in your business. So that's the first. And then, of course, divided by your revenue. So you have a percentage. It shows you, oh, this is the gross profit margin that I'm making on my business. And we'll see a short description of that. Your operating profits is just another line item after your gross profits. Now, I mentioned that you have direct costs. You also have indirect costs. These are like your sales and marketing costs, your administrative expenses. Once you deduct that as well, you have your second line item, which is your operating profit, right? And then, of course, to achieve the margin, you divide that by revenue as well. Lastly, to achieve your net profit, you're going to deduct the first line item, which is your revenue, minus your cost of goods sold, now minus your interest and your taxes. Because I mentioned earlier that, the more you rake up interest bearing liabilities, you have an impact on, your overall profit as well. So if we look at this scenario, which company, I mean, you can drop comments, in the comment section. If you look at this summary now, there are like 4 companies. At first glance, you want to be company C. You also want to be company D. I mean, lastly, company A is like, you're not even looking at being the company B, because if you look at the first line item, you're seeing that the gross profit margin, I mean, this is the highlighted in yellow, the section that is highlighted in yellow. You see that, okay, the revenue for company A is 70 and the cost of goods sold is 40. If you do the difference, you have 30. So 30 divided by 70, you're going to get the first gross profit margin for company A, and that applies across board to company B, C, and D. As I've mentioned, if you look at this, originally you want to be company C and D because they have what? Higher gross profit margins. Now, our next line item, as I mentioned, is the indirect cost. We have high indirect costs across all the companies. Once you do the deductions again, you deduct your operating expenses. You no longer want to be company A. Company A is already on the negative. You no longer want to be company B. I mean, the last 2 companies you would most likely want to fall is company C and D, which is essentially pharmacy, C and D, right? So lastly, if we deduct our interest and our taxes, and we divide that by our revenues, the company that stands out here is company D. Now, if we go back to the revenue, we see that company D has the highest revenue. They still have the highest cost of goods sold and the highest operating expenses, but they're able to achieve a net profit margin that's higher than the other businesses because they were able to shoot up a high revenue position. So it is very important that while you're minimizing your costs, you're also ensuring that you're projecting a high revenue to enable you cover your direct and indirect costs. And I would introduce the concept of the break-even point because at the point where you're able to cover this cost and essentially, be at equilibrium, meaning you're not making a profit, you're not making a loss. That is your break-even point for your business. And I mean, no one gets out of bed because they want to be at break-even point. So the at the end of the day, you want to make profits, right? Okay. So your break-even point, is the level of sales where your total revenue equals your total cost, and it's resulting in a no profit or a no loss position. But as I've mentioned, no one gets out of bed because of that. But at the end of the day, you have to achieve break-even point before you even, move over to having profits. So
Hi,
first of all,
hi,
hello.
hi, Jumai.
Yes, please.
I will give you grace of 5 more minutes.
Okay, thank you. Thank you for that.
Yeah.
All right. So rounding up, to calculate your break-even points, of course, that's dividing your fixed costs and divided by your contribution margin, which is the difference between your selling price and your variable cost. So if we look at this representation, a company that has a fixed cost of 100,000 and of course a variable cost, they have a quantity of 10,000 that is sold. Your break-even point is the point where your fixed costs, you have a fixed cost that is standard. Your break-even point is where your revenue and your total cost intersect. For this company, their break-even point is $120,000. It means that they have to generate this level of revenue to neither achieve profit or loss. It means that for this company to make profits, the company has to sell and generate revenue above $120,000. So essentially, break-even point guides you as a business as to how do you minimize your costs and maximize your revenue for you to be able to achieve some level of profit. And I know that there are several challenges as a business that you encounter in terms of trying to achieve your profitability. Price competition, there's a lot of fluctuating prices, and of course, you have to ensure that you deal with a supplier that gives you the best prices. There's generic substitution in the market. There's also some inventory that is slow moving. So you have to, like Yusuf mentioned, you have to do a lot of demand planning, project, and say, okay, between this quarter last year, this was my trend. How do I use that feedback to plan for the next coming months? And also, it's super important that you understand the market saturation, the market that you play in, to be able to make these plans as well. There are some softwares that would ensure that you achieve these goals, because you can't necessarily take bits and pieces of your business and plot graphs and all that. So there's essentially softwares that can help you achieve all these results seamlessly. Once you input the information correctly, you don't have to be a professional like an accountant to be able to achieve these results, but it will help if you have some level of guidance from your accountants as to achieving this. So the essence of all this is to give you an insight to understand, even when you see these variables, when you see these line items, they're no longer new to you. So this is like an introduction into this profitability drivers that will help you to remain in business. And these are some of the questions that were raised. I'm sure that during this session, the next session for our questions, we'll be able to take up, as many questions as you have. I'm hopeful that, we'll be able to cover given the short time that we have. Yeah. So thank you, Yoande.